Hello investment champions, and welcome back to the channel. I would like to share with you my second video of the Investing Quotes series today. This is one of the most famous and oldest quotes from Warren Buffett. This quote is on the level of investment classic. Before anything else, let's see today's program lineup. What is the quote and idea behind that? What is price, and what is value? What is margin of safety? Some words about company valuation. A few words. I added timestamps to the above topics, but I request that you watch the whole video to get a complete idea. Okay, let's look at our quote today. The quote is, "Price is what you pay, value is what you get." The idea behind this quote is that, although we pay a price, what we get is value. Let's explore this quote more thoroughly. Why is it so important for stock market investors to understand? Let's find out. First of all, we need to distinguish between price and value. Price is the amount of money that you have to pay to buy a stock, which is determined by the supply and demand of the market. Value is the worth of the stock based on its future earnings, growth, competitive advantage, and other factors. Price is objective and observable, while value is subjective and estimated. The key point that Buffett is making is that price and value are not always the same. Sometimes, the price of a stock is higher than its value, and sometimes it's lower. This creates opportunities for investors to buy stocks when they are undervalued and sell them when they are overvalued. For example, suppose you want to buy a share of Microsoft, the technology giant. You look at the market price and see that it's $300. But how do you know if that's a fair price or not? You need to estimate the value of Microsoft based on its earnings, growth, net assets, cash flow, and other factors. Suppose you do some research and analysis and come up with a value of $400 per share. This means that Microsoft is undervalued by the market, and you can buy it at a bargain price. You are paying $300, but you are getting $400 worth of value. On the other hand, suppose you want to buy a share of Netflix, the streaming service provider. You look at the market price and see that it's $600. But how do you know if that's a fair price or not? You need to estimate the value of Netflix based on its earnings, growth, net assets, cash flow, and other factors. Suppose you do some research and analysis and come up with a value of $400 per share. This means that Netflix is overvalued by the market, and you are paying too much for it. You are paying $600, but you are getting $400 worth of value. The difference between price and value is what Buffett calls the margin of safety. The bigger the margin of safety, the better the investment. Buffett likes to buy stocks when they are trading at a significant discount to their intrinsic value and hold them for a long time until the market recognizes their true value. This is how he has built his fortune over the decades, by being a value investor. But how can you estimate the value of a stock or any other asset? There is no simple formula or method that works for every case. Different investors may use different approaches, such as discounted cash flow analysis, earnings multiples, book value, dividend yield, or other metrics. I will teach you the main valuation methods, like book value and the discounted cash flow method, etc., in future videos. The important thing is to have a rational and consistent way of valuing things and not rely on emotions, hype, or speculation. Another important thing is to have a long-term perspective and not be swayed by short-term fluctuations in price. The market can be irrational and volatile in the short run, but it tends to reflect the true value of things in the long run. As Buffett says, in the short term, the market is a voting machine, but in the long term, it is a weighing machine. So, the next time you are thinking of buying or selling a stock, remember Buffett's quote, "Price is what you pay, value is what you get." Try to find the value of what you are buying or selling and compare it with the price. If you can buy something for less than its value or sell something for more than its value, you are likely to make a good deal. And if you can do this consistently, you are likely to become a successful stock market investor. This is less than 0.1% of investment knowledge. There is 99.9% more to learn from us. Join our channel, and we will share our comprehensive knowledge with you. You can also achieve financial and time freedom, like I did at a young age. Thank you all. Improving knowledge is the only way to become a successful investor. I can show you the right path to achieving that goal. See you in the next video.